Okay. All right. Todd, can you confirm you see everything on your end?
Yep, looks good.
Perfect. All right. Good afternoon and good evening, everyone. I know we've got a few different time zones joining, so I really appreciate you guys joining this evening. Really excited to talk to you tonight about Regal Apartments, the opportunity here. First and foremost, a couple of logistical administrative things. Number one, we'll be recording the session, as you probably can see by the recording emblem, that you can reference later on. I'll be sharing the link for those that can't make it tonight. You can go back, check it out, replay, ask questions after the fact. No issues there. Number two, there's a chat window at the bottom. My lovely colleague here, Todd Dexheimer, you can wave to everybody. We'll do introductions here in a second. He'll be handling the chat and Q&A throughout the session. So if things pop up on your mind, you want to capture them, he'll do his best to try to capture that. He'll be on mute for a lot of it. We'll tag him in and out of different sessions, but he'll be doing his best to answer questions as we go along. And at the end, we'll do a final Q&A, kind of a call for open questions, things that might benefit the larger group to cover in general. So if all that sounds good, I'd love to jump in. So a little bit of background here. So as most of you know, you've been begging me for, Andrew, you've been talking up this multifamily thing. We haven't done a deal in quite some time. In fact, it's been about 10 months since we've closed the last one, and we've underwritten and looked at, I'd say, close to 200 different properties in the last 10 months since we closed the Carolina deal back in May. And a lot of them we've gotten close on from a deal perspective, and the underwriting might have looked good, but maybe the team wasn't quite up to our standards. And maybe the other way around, the team was really solid, but the underwriting was a little bit beyond our reach. And really looking for that perfect fit for both, ourselves as a team and Redline and the right partner. It had to be the right fit. And I'm pleased to present Regal is the right fit. I'm really excited to share with you guys the detail and the team and everything behind that. So without further ado, we'll walk through, we'll jump in a second here. Trying to get on a slide. Just a quick outline of what we're covering. We'll talk about the team and what's going on there and everybody's roles and responsibilities. Let's look at the property and where the value add components are here. We're gonna look at the area, the submarket, the broader Louisville MSA, prior purchases that are very relatable to this property. I'm gonna get into some of the numbers, the expected returns, and then finally we'll wrap up with some timeline and next steps and Q&A. So the team. So you guys all know me on the call. I don't think I needed too much introduction there. You know the name Redline. You know we acquire and operate and improve generally multifamily properties. Endurus Capital, we've got Todd here from Endurus. Say hello, Todd, in a second. What I like about working with Todd and the team there is kind of what they stand for. Their values very much align with what I'm looking for. Not only are they great operators, they're great people in general. Like I said, their values align with ours, and they're really, really big into not only benefiting their investors. There's a lot of different ways to make money, but as you can see on the first statement, the first sentence in their mission statement here, they're all about improving the lives of the residents and the surrounding communities. And there's a lot of operators I can tell you that say that, but they don't have the track record that this team does. That speaks, the examples speak for themselves, and we'll show you a few of those stories here in a second. So I couldn't be more excited about partnering with Todd and the Endurus team. I've been following Todd for quite some time, and a number of years here. I've been a mentor. He's been a mentor of mine. Been following a lot of their properties, their work, and their story, and it's really, really impressive. And I'm really excited to share some of those examples with you guys here in a second. So let me go back up. Sorry. So you guys all know me. I won't spend a whole lot of time there, but I will take a minute to introduce Mr. Todd Dexheimer, and he's going to talk to the rest of the Endurus team.
Yeah, absolutely. Well, thanks, Andrew. So Endurus team is myself and two partners, and we have collectively been investing for over individually over 13 years. Drew and myself and Matt 10 years, and we currently own about 4,000 units. And so excited to be partnering with Andrew. Drew Whitson, one of my partners, his specialty is finance, and he's a finance professor, Bethel University. And so he kind of covers that aspect, anything dealing with money, with lending, with the numbers. Drew Whitson he's that part of our team. Matt Bronner, he's kind of your organizational wizard, the asset management, that type of portion of the property. And myself, and I'm investor relations and construction management. And construction has been a big part of my background. I've got a contractor's license. I've been a contractor for over 10 years, actually 12 years now. Worked my way through college in construction, and so that's a big part of my background is managing the construction phase. As you'll see on this project, it's a very heavy value add, and we are actually bringing in we're hiring in-house a project manager, Anthony Metzger, and he is going to be living at the property. His sole purpose for being there is to manage the construction, making sure we're on budget, making sure we're on time, managing the contractors, managing the materials. And I'm going to be in communication on a daily basis with Anthony and making sure this project is on time, on budget, and on point.
Awesome.
So then I also want to introduce Denton Floyd. So Denton Floyd is a property management company. They're based out of Louisville. I actually owned 2 properties in Lexington, Kentucky. And those properties, we had a different management company on. They struggled quite a bit, and hired Denton Floyd. And within 8 months, Denton Floyd had completely turned those properties around and renovated, helped us complete the renovation, got the occupancy from 76% occupancy up to 96% occupancy within just a few months, and allowed us to complete a full turnaround and sale of those 2 assets. And so super excited to be bringing Denton Floyd back on. They manage over 5,000 units. They're a fully integrated real estate management company, company with property management, construction management, and so forth. And their sole focus is Louisville, Lexington, a little bit into like Ohio, Cincinnati area, and some of Indiana, but they're very focused in this area. And then lastly, we've got Contractors Inc., which will be one of our main general contractors. And Contractors Inc., they're working with us in a couple other large projects that we have going on in Tennessee right now. Been very good partner for us on the construction side. And so we are going to be bringing them on board to, like I said, to help with a lot of the construction for that aspect.
Great. Thanks, Todd. Let's jump in and talk about the exciting parts, the property itself. So let's start with the neighborhood. I think what's really, really cool about, finding a diamond in a rough like this, I truly believe it is here, is this property is in a really nice neighborhood. It's an A-class area, really nice amenities all around. And the building itself needs, some TLC, right? So if you look at a lot of the comps, they're a little bit above this in terms of, the attention to detail and maintenance, the renovation levels, et cetera. But the good news is this property has major scale. So it's 228 units. So it's a sizable building across 19 different buildings, and you'll see the footprint and layout of the different buildings here in a second. They're very much in a close proximity to each other from a maintenance point of view, from a scale and economic point of view. They're right next to each other, so really easy to get around from one to the other. I think one of the biggest selling points is just the pure sheer size of each unit, right? If you look at some of the comps, they're all, and we'll show you those in a few minutes here, they're all lower than this. On average, from the 1 to 3 bedrooms, they're almost 1,300 square feet. And for those that haven't seen the comps yet, or haven't seen additional other apartments that are comparable, these are way bigger. And I think that's really exciting. So if you look at where we're going to take these post renovation, we have a complete advantage over a lot of the other units and comps in the area, which is really great. I talked about the Hurstbourne neighborhood. That's a submarket. I talked about being Class A. I mean, the income levels speak to that itself. It's 130,000 about a median household income. And I looked up the average, and it's close to 170,000 family household income. So, which is really, really great, and it more than supports the post renovation rent levels are looking at. There's a lot of attractions. We'll show the map here in a second. Restaurants and food and shopping, tons of employment nearby, major easy access to the major highways. There's 2 major highways nearby. We'll show those in the maps here in a second. And the great news is already a ton of amenities. There's a pool there, there's a clubhouse, a fitness center. There's already been some heavy lifting done there. We're going to be adding on to that. We're going to be adding a dog park, we're adding a dog wash, a fire pit, and cleaning up some general space around the pool. We'll talk about that in a second. So what are we doing? If everything's so great, what can we improve on from a capital improvement standpoint? What does the value add plan look like? So we'll start with the exterior, right? It starts with the landscaping, cleaning that up, tidying it up. And I would call this more of a transformation, right? This is not your traditional, resurface the countertops and paint the walls and put a new carpet. This is truly, full exterior renovation. You can see the list here. It's windows, exterior paint, siding, it's fixing the roofs, it's parking lot resurfacing. It's adding those amenities we talked about. And that, that's really going to drive the tenant base we want. It's going to really brighten up the community itself. And then you move into the interior. Once, you draw people in from a really nice exterior, position the unit well, adding new flooring and painting, remodeling the kitchen and bathrooms, granite countertops, tile backsplashes, all the stainless appliances you'd expect to see in a Class A neighborhood. If you look at, we'll get into the pictures here in a second, the existing finishes are more Class B, maybe Class C level. I mean, there's been some work done, but they're nowhere near the standards of what the comps are looking at. If you look at the difference in rent compared to the comps, you'll see why right now. And we got some code things to tidy up around plumbing, electrical, and some, general common area space like the hallway and lighting. We're going to take care of that as well. And here's some pictures. You guys can see kind of what I was just referring to. There is a really nice fitness area for the tenants. The middle picture is the common area where they can hang out, socialize, etc. And then there is a really nice pool. It does need some TLC, as you can see. Some of the patches of concrete need to be ridden down. I'm going to clean that up. And I believe we're looking at heating the pool year round too. Louisville doesn't stay warm year round, unfortunately. So we're going to try to maximize that outdoor space for the tenants who are there year round. Some other pictures here. You can see they've done some flooring and painting work already. Some of it's lower tier, what I'll consider lower tier finishes. They're not quite up to Class A standards of what you'd see in the area. But you got the older countertop and cabinet in the bathroom. They've done some lighter work, kind of mismatched appliances that don't match the cabinets. So again, there's been some work done, but we're looking to really bring this up to Class A standards overall. Some more pictures of the bathrooms in the common area. You can see again some work has been done. You look at the hallway; it shows its age, right? It needs some love, some TLC, some paint, carpet, some tidying up on the outside and inside overall. So I talked about the kind of layout and proximity to different buildings. Here's all the different 19 different buildings. So like I said, from a maintenance perspective and from a construction efficiency standpoint, they're all really close by. So when there's a maintenance call, we're doing the capital improvements, easy to get to from one to the other, and it's easy to access building to building for the different tenants that may have friends or family in the area, which is really neat. Here's another view aerial wise, kind of just emphasizes the same points I've already been making. You can see close proximity to Highway 64, and there's another one nearby you'll see in the loop. Here are some of the amenities in the area. I talked about tons of restaurants and shopping. Here are just a few examples. This orange arrow here is Regal, and you've got lots of shopping, restaurants, like I mentioned before. So if we zoom out to the broader, we talked about the Hurstbourne submarket, I'll call it. Let's talk about Louisville as a general MSA, a statistical area. So if you think about multifamily investing, apartment investing, what's really important and what are the key factors that, inevitably there's going to be another recession, who knows what happens with Russia and everything going over there. How can we mitigate some of that risk? How do we, as they say, stack the deck in our favor? So we like to look for a few main things when we look at a market for pursuing property or investments in general. One is jobs, right? Are there jobs? Are they growing? Is there an increasing number of jobs? The second is people. Is the population growing or is it shrinking? If you look a lot where I live in the Northeast, people are exiting, right? So we're looking to invest in people where people are going, where employers are investing money, and quite frankly, where wages are going as well, right? Because if you're looking for rent growth, which by the way, Louisville, I believe was double-digit growth this past year, and we're underwriting the next few years quite more conservatively than that. But it's growing. I mean, there's a high demand for jobs, and as you'll see here, a lot of major employers investing a lot of capital into the area. So job growth, income growth, population growth checks all three boxes. As most of you know me and my professional side of the job, big into logistics and supply chain. And this is one of the major hubs, as along with Memphis, for the UPSs and FedEx of the world, just because of its proximity. I think it was a cool stat at the top of the screen here that 60% of US cities are within a 1-day drive of the metro, which is really cool. So you can really get to any corner of the US pretty quickly. So it makes it very attractive just from a geographic perspective. They've got the tourism that everybody knows. The Derby is probably the #1 thing they're known for. I believe they're called the Wall Street bourbon capital of the world, right? So there's some tourism dollars being injected there. And then just from a general job and economic standpoint, they've got manufacturing. I already talked about logistics, life sciences, healthcare. So it's not like it's a one-trick pony in terms of, hey, they're only in manufacturing, they're only in one particular area. We like to see diversity in employment as well, which is really cool. So I mentioned the jobs. What's really cool is between Kroger, Quadrant, and other major employers, added over 800 jobs in 2022 alone, and they're continuing to grow. And you can see companies are continuing to invest in the area. They believe in the growth of the area. And if you zoom out a bit, of course, the last few years have been growing well, but if you zoom back to 2011, they've added more than 80,000 private sector jobs, which is really great and far above the US average. So again, we talk about stacking the deck in our favor, increasing the odds of success. These are the things we look for. And this is why we're so excited about the location, the general Louisville market. So let's get into some past prior purchases. And a couple of these, I've been following Todd and the Endurus team pretty closely. And the first couple of these in this list are really close to the same type of business plan and are almost, models for what we're trying to do here at Regal Park. I've been following the Idlewild 45 project since its inception back in 2020, and it's been hugely transformed. And if you saw the old pictures, you wouldn't even believe it was the same building. And I love that the team has done the exact type of work. And I mentioned earlier about making a difference in the community and the residents. And these two properties, Idlewild and both Kimber Towers, that sister property, have been totally transformed, exterior, interior. Todd's had a bunch of pictures out on social media, and it's just amazing what they've been able to accomplish. And we're looking to do pretty much a copy and paste of that. And you can see the financial results. They bought, let's say, Kimber Towers, the most recent one. I think it was April last year, Todd, that you guys closed on that. And they've added significant value to that property, from 9.3 to 16 million in a very short period of time. I mean, that won't happen every day. The economy was in our favor in this case, but again, the team was able to execute quickly. The construction company is similar, and just we're looking to cut and paste that same result. And there's some other examples. These are just a few. We've got Park Lawn, a smaller property from Endurus as well. A few other examples, Covington Hills, I believe, is the first property, that Endurus formed together collectively on. A few others in Minneapolis. So, quite a bit in Kentucky and Minneapolis as well. I want to pause here for a second on Cambridge and Ashland. These are two other great examples that they've exited. And Todd mentioned the history with the property manager. These two are both managed, you can see, by that same company, Dent Floyd, and you can see the occupancy changes. You can see the growth and the value that was driven in pretty short periods of time, right? These were both purchased in 2018, exited just in 2020. So they really turned them around quickly, and that's what they specialize in. Another pro, I think, for Dent Floyd is I like to see property managers have the experience as investors, right? So they also invest in properties both passively and actively. And that's a really great sign. They know exactly where our head's at. They know exactly what our investors are looking for, which is great. Two properties in the Redline sign that many on the call are very familiar with, and most of you invested in, just showing the progress there, right? We picked up LaGrange in April of 2021 last year. We've completed about, I'd say, only a third of the unit turns. Labor has been slow. We took the occupancy way up. And the recent BOV for that, as an example, we actually got a range from 7.2 to 8 million. We were approached with a few off-market offers back in December, which we obviously didn't socialize, but there's a reason someone's willing to pay that value that early in just less than a year of ownership, right? So again, just adding to the track record of the team. Let's get into some of the numbers. So overall purchase price, 32.5 million. And I should note that with the strength of this team, this was an off-market property, by the way. With the strength of this team, we were able to secure the deal against many other competitors, even being off-market. And actually, we weren't the highest bid. We were about $1 million under the highest bid, and we were actually with half the earnest money, the next closest competitor. So after some interviews with the seller, the team was able to secure the deal. Just based on the track record, the reputation, some references from the lender, they felt really good about getting us to close and taking the property on its right course. So that really went a long way. And I think it shows the value of almost immediate equity in the property, which is really great. So renovation budget, just a little over 5 million, and it's about 22,000 a unit. Like I mentioned, it's a heavier lift value add property, exterior, interior, all that. And that does include some contingencies. I know many have asked me even offline, hey, Andrew, are you worried about labor costs or inflation or anything like that? And yes, that's a risk. And we've accounted for, a buffer in there in that budget as well as the reserves, which we'll talk about in a second. The loan amount of 30 million, just over 30 million, does include the primary loan as well as the financing and renovations. When we talked to the lender about this one, they're so confident in the team and the ability and so excited about the project, they're willing to lend the CapEx portion of the project as well, which is really great. So again, back to being conservative and then with the underwriting of the property and the operating of the property, we've got almost $1.5 million of between operating and interest reserves that give us quite a bit of cushion. In fact, for this size deal is a lot more than you would typically see in a deal of this size, maybe from other groups or other syndicators. So all in, we're raising about $10.5 million. We've got a great chunk of that already going. That's pretty much the summary of the project itself. On the opportunity side, minimum investment we have set at $100,000. For those that are really interested, like the deal, like the property, like the team, and you're a little bit below that, let's talk. Depending on your situation, let's see what we can work out. If you like the property, that should be number one. Give me a shout. Let's talk through it. If you give Todd a shout as well, let's talk through what makes sense for you. We'll make it work. And as far as the investment classes of shares, this could be confusing, so I'll talk through this. We've got two options really. So when you invest, you've got the option for Class A shares, which is a straight 10% preferred return, which would start in the first quarter with quarterly payments and no participation in the upside. So that that's the maximum you can earn possibly. Now we'll say that Class A shares are limited because they're consuming cash flow of the property. I think we're limited to about 800,000, and a good chunk of that are already gone. So if you're interested in the Class A piece, you're looking for this consistent, higher stacked 10% return, give me a shout almost immediately because they're almost full. The majority of us will be, including the general partnership team, Todd, myself, and the rest of the Endurance team will be investing in Class B. And what that means is we'll have a slightly lower pref of 7%. But we're also participating in the upside of the deal. So we're splitting 75% to limited partners, 25% to general partnership, but we are participating in the upside of the deal. And the way it's underwritten, we're right between 15 and 18%, with the current underwriting at 16% over a 5-year hold period. And for those that might be sitting on, some serious capital gains from real estate, or maybe from other properties that you're looking to offset, we will, especially in year one, we're expecting some significant tax benefits. So we will be doing a cost segregation study. So that will benefit you looking for those write-offs in year one. This is a great place to look. So let's talk about comps. Our current rent roll, you can see here's the 228 units and how they break out today. The average property rent is only $945 a month. And you look at, I'll show you the comps here in a second across, a handful of properties. The average market rate's $1,225. And in fact, if you go out and you Google, if you look at the average 2-bedroom, 3-bedroom in this area and this Hurstbourne neighborhood, it's well above that. So we're really excited about the potential here. You can look, I think we have quite a bit of upside already underwritten, and a lot of that's very conservative. I think there's a lot more room to go considering the size of these units. And again, 910 square foot for the 1-bedroom, almost 1,300 for the 2-bedroom, over 1,500 square feet for the 3-bedroom. So you'll see the comps here in a second, but huge in size, massive upside potential, $300-400 plus a month across these units. And this market is very hot, high occupancy. It does not take long to get units leased up in this submarket right now. So here's some of the comps you can see across different size buildings, different vintage. all with comparable amenities. You can pick up pretty quickly that if you look at some of the larger units here and some of the rents they're getting, like you look at Plainview, for example, the 3 bedrooms is fetching $1,500 plus in rent, and the square footage is 1,361 compared to our 1,500. And you can see the different examples. I'm picking on that one because it's a good example, but there's many others. Huge amount of upside. I think we're very conservative in our rent projections, especially in the 2 and 3 bedroom where the bulk of these units lie. So really excited about that. So how does this all roll up? You look across the 5 years. Again, we talked about a 5-year hold. What I like a lot about how we underwrote this deal is, first off, we're very conservative about the ramp up period in year 1 and year 2. It's underwritten with very, very little, ramp up right off the gate. So it gives us a lot of time. We've outlined 24 months to do all the renovations. However, we'd like to think that we can get that done at the most in 18 months or sooner. So we're being very conservative with projections, but we are very optimistic we can be faster than that. Another plus I like here is we're cash flow positive, or like the break even right away out of the gate. So no negative cash flow, no eating of the reserves out of the gate. Another positive I'd like is the rent growth, again, is well below what CoStar and Yardi are forecasting. And we're actually projecting that rent and expenses kind of trend in the same direction or underwritten at the same percentage. So if we have it, let's say 4% rent growth, we're also assuming expenses will grow the same, which is not always common, I can tell you from other operators and the way things are underwritten. So for those who want to dig in further, they're kind of the highlights of what I like about it. I'm happy to answer and field more questions around the details and share more intricate details for those who are interested. But generally, at a 16% return with very conservative parameters, with a lot more upside potential, and really exciting stuff there. I think it's always nice to see, we talk about the minimum of 100,000, what that looks like over a 5-year period. So as you can see, pretty back end loaded. Again, we're conservative ramp up period. Yeah, you will see other syndicators and operators will forecast more cash flow in year 1. And the reason either a couple of reasons for that. Either A, they could be more aggressive in what they're assuming that they will be able to ramp up the construction and turn units, or they're taking, they're over raising more than they need to, and they'll return back to the operators early in a deal, which isn't a good use of capital, and it just kind of inflates and it's not really a good return or a good metric to use. So again, pretty back end weighted in years 3, 4, and 5. And I do think the teams agreed that year 2 it's probably too conservative, that we'll think we'll be closer to, the 3, 4, 5% mark in year 2. But again, just to be conservative, we're not projecting to distribute until year 2. So that's it for the numbers. Let's talk timeline, and we'll get into some questions here in a second. So we're really excited about the deal. And as you guys have seen, I shot out an email, and a few of you already have gotten into the train early, getting into commitments. So you'll see a link coming out to sign up for the portal. You can view the documents. You can view the recording. You can view this summary document here. We'll start getting everything teed up in the system in the portal. So look out for that link. Right from the portal, you can sign the subscription agreement, which is really handy. You can view the documents I mentioned. There's even wiring instructions to get everything funded. We're shooting for an April 22nd closing. We'd like to have all funding in. We need to have all funding in by April 6th. So if you've got any questions at all between now and the next couple of weeks, please don't hesitate to reach out. Things are moving pretty quickly on our end and with the other investors. So we want to make sure we stay on track and don't have any delays there. So the next, following closing, we're looking at, again, turning the units around at most in a 24-month period. And we'll assess options for a refinance. And another thing I really like about the way we underwrote this deal that's conservative as well is we're not expecting to refinance. That would be a bonus, but there is a strong potential that would be an option, especially with us really driving the operating income of the property in a very short time frame. We'll be looking for options, but again, we have no crystal ball, so no promises there. And there's a reason we did not include that in the underwriting, but we'd like to think that's a very strong possibility in the next couple of years. So before we get into Q&A, maybe we'll tackle a few commonly asked questions, and I can add some color here as well. Number one question we get asked all the time is, will you guys be investing in the property? Do you have skin in the game? And the answer is a resounding yes. We'll be investing as a partnership. I think it's actually closer to $600,000 into the asset. So plenty of plenty of excitement around this deal for us, and we're more than happy we want that pref as well. We want that return and we want the upside. So we'll be on the Class B side. What are the requirements to invest in a deal? I guess number one is you have to have a pre-existing relationship with someone from my side of the fence or from Todd's, from Endurus, with one of the general partners. I will say it's open to both accredited investors and non-accredited investors. There is a limited number of non-accrediteds, but I think we've got some room there. So let me know what you guys are thinking there. So what's the minimum amount? We talked about the minimum of 100,000, but again, depending on your situation, if you really like the deal, let's talk through your situation. Let's see what works. I'm sure we can work something out. Another question we get is, can I invest in my IRA, specifically, self-directed, solo IRAs, et cetera? And the answer, of course, is yes. Next question, how long do I have to make an investment decision? We can start accepting commitments. In fact, we've already taken quite a few starting today. And in fact, we started last week on a first come, first served basis. That's exactly how we process. We don't give priority to one or the other. We just take them as they come in. So get your PPM signed if you're interested, this week or next week. And we'll start funding and plan for wires by April 6th. Next question, how will we distribute profits to investors? I mentioned this before. So the A shares will start on the first quarter with a 10% annualized return. Again, it's not a guarantee, but they do get priority preference in the cash flow. And we'll start that one right away. Class B shares will get a 75 split on all profits paid out in quarterly, but we do not anticipate for the Class Bs distribute, as you saw in that prior graph, until the end of year one. So they're the difference between the Class A and Class B. And like I mentioned, the Class A's are super limited. So if you're interested in that one is very timely. So please reach out right away. Otherwise, Class B, either way, let us know, because spots are filling quite quickly already. Last piece around tax benefits as a passive investor. Yes, we are sharing the depreciation and splitting accordingly for long-term capital gains. So again, if you have heavy gains from this past year coming into 2022 or in 2022, there is an option for that. And you will for sure have some room for this coming out of the cost segregation for a pretty heavy write-off against your real estate gains. And like I mentioned, we are doing a cost seg study. And then finally, before we get to Q&A, here's our contact information. You guys already have mine, I am sure of that. But here's the rest of the team. Check us out on LinkedIn. Contact any of us with questions as you see fit. You've got my link for the site, which of course you already have. So I'll leave it at that. And I'm going to jump back to Q&A. So Todd, can you tee up some questions for us?
Yes. Let's see here. It says, can you quickly recap how this deal was sourced?
Yes. So I think I mentioned this earlier. I'm not sure how recently this question came in.
This person said he came in late. So
no worries at all. So this was an off-market deal. I came directly to the Endurus team based on prior relationships. And the cool part about this was, and if you missed this part, I think this is really interesting, that we were actually not the highest bidder. We were not the highest amount in earnest money, but based on the reputation of the team, our track record, and our ability to close, we were selected at $1 million less than the highest offer. So I hope that answers that one. Next one.
I saw the IRR and pref, but what does the AAR come out to? And yeah, I don't know if you calculated that. We never calculate that, the ARR, but yeah, so I guess I can't answer that quickly.
I think we may have it in the underwriting, so I'm happy to follow up with that one offline. I'll grab a name and happy to close the loop. Any others?
That is it right now. So if anybody else has any questions, jump in and ask them.
Cool. It's certainly not the last opportunity. Plenty of time this week. Please give me a shout, phone call, email, bat signal, whatever it may be. Let's talk. So just to close things out, again, we think we've got the right deal, the right terms, a great team in place, in the right market. So really excited about this. I'm looking forward to working with you guys again, most of you, and looking forward to the opportunity, and would love to have you invest alongside with us. Thanks for joining.
Awesome. Thanks, everyone.
Thanks, everyone.